All right, let's dive straight into something that could really impact your daily life, from what you drive to India's whole economic picture. The recent GST reforms hitting the Indian auto sector. We've got a lot to unpack here about what these changes mean for car prices, bike sales, and even some companies you might not immediately think of.
Indeed. These changes are pretty significant, host. They aren't just minor tweaks, especially when you look at how the market was doing just before this.
Yeah, definitely.
So our goal today is basically to walk you through the key shifts, the details, and maybe more importantly, what the wider effects might be, give you the full picture.
Okay, so to set the scene properly, it's important to remember the Indian auto sector wasn't exactly firing on all cylinders before this.
Not at all.
It was facing a bit of a slump, actually. If you look at passenger vehicles, sales actually went down by 1.1% in the first 4 months of FY26.
Right, fiscal year 2026.
Exactly. So that dip, it wasn't just a blip, it really signaled a need for, well, something to give the market a boost.
And that something came from the GST Council. In their 56th meeting, they approved a new, simpler tax structure. 2 main slabs,
Right.
5% and 18%.
Okay.
And crucially for this discussion, there's also a special 40% slab that's specifically for things classified as luxury items.
Ah, right.
This whole package, it kicked in on September 22nd. The idea isn't just changing numbers. It's about making the whole GST system simpler, more transparent.
Easier to navigate.
Exactly.
Yeah.
And hopefully injecting some life back into the auto sector, which, as you said, really needed it.
Okay, now this is where it gets really interesting for you if you're maybe thinking about a new vehicle. Let's get into the nitty-gritty. How do these tax changes actually affect prices? Segment by segment, where's the biggest impact?
Okay, the most dramatic change, no question, it's in passenger vehicles, specifically small cars.
The hatchbacks and compact sedans.
Precisely. Before, they had 28% GST plus an extra 1 to 3% cess. Those extra taxes for specific things.
Right, so effectively 29 to 31% total tax.
Exactly, that whole structure, gone. Now it's just a flat 18%.
Wow, okay.
No,
That's a big drop.
it's huge. We're talking about a price reduction of roughly 12 to 12.5% on the ex-showroom price. It really changes the affordability calculation.
12.5%. Can you give us some examples? Put that into perspective.
Sure. Think about a Maruti Suzuki Alto K10. The 1.0-liter one.
Very popular car.
Extremely. Its price could potentially fall from around, say, 4.23 lakh rupees down to about 3.81 lakh.
That's over 40,000 rupees saved.
Right there. Makes a real difference. And it's not just the entry level. Models like the Swift and Desire, also from Maruti, could see drops around 60,000 rupees.
Okay.
Even something like a Tata Nexon-based model. If it meets those specific criteria, sub 4 meters long, sub 1200cc petrol engine.
Ah, the small car classification rules.
Exactly, those rules. If it fits, it could drop by as much as 80,000 rupees. That's a serious incentive. Puts new cars within reach for a lot more people.
Okay, so small cars are the big winners. What about larger cars, SUVs?
They also benefit, though it's a bit more modest. Their old tax rate was pretty high, between 43 and 50%. That was the 28% GST plus a hefty 15 to 22% cess.
Right.
That's now simplified to a flat 40%.
Yeah.
So getting rid of that high cess still leads to a noticeable price cut.
Not as dramatic, but still lower.
Exactly. For instance, a Hyundai Creta might see its price drop about 3%. Mahindra Scorpio, the Star, they're also expected to get cheaper. It makes those aspirational vehicles just a little bit more accessible.
Okay, so that's cars covered. What about two-wheelers? Huge market in India.
Absolutely huge. And here, the mass market bikes, they're really celebrating.
How so?
Two-wheelers with engines up to 350cc, their GST rate gets slashed from 28% all the way down to 18%.
Same as small cars then.
Pretty much.
Yeah.
And here's the kicker. The industry reckons that something like 98%.
Yeah.
98% of all two-wheeler sales fall into this category.
Wow, 98%. That's basically the entire market almost.
It covers the vast majority. Think commuters, everyday bikes. It's enormous for them.
So again, can we talk specifics? What does that mean for popular models?
Okay, take a Royal Enfield Classic 350, iconic bike.
Definitely.
It could potentially drop from about 1.93 lakh rupees to roughly 1.73 lakh. That's a 20,000 rupees saving.
Significant?
Or even like the Hero Splendor, you see them everywhere.
The workhorse bike.
Exactly. Could go from maybe 79,400 rupees down to about 71,400. These are real, meaningful price cuts for millions of people. Really helps with affordability and access to transport.
But is there a catch? You mentioned the 350cc limit. What about bikes above that?
Ah, yes. There's a nuance there. The flip side, if you will. Motorcycles with engines bigger than 350 cc, they're now officially classed as luxury items.
Okay, and that means?
That means their tax rate has actually gone up. It was 31%. Before that was 28% GST plus a 3% cess. Now it's a flat 40%.
Ouch! A jump from 31 to 40%.
It's a significant hike. But importantly, this segment is tiny in terms of volume, only about 1 to 2% of the total Indian two-wheeler market.
So it affects premium bikes, but not the masses.
Exactly. So like a Royal Enfield Himalayan 450, that's 452 cc, might see its price climb from around 2.85 lakh to maybe 3.0 lakh.
Okay.
And a Bajaj Pulsar NS400Z could see a hike of around 13,000 rupees. So yes, an increase for that niche, but the policy clearly prioritizes mass market affordability.
That makes sense. Now, you mentioned something crucial earlier that often gets missed. Tractors and farm machinery. What's the deal there?
Yes. This is really important for the agricultural sector. The GST Council clarified things. Tractors and farm machinery will now attract just 5% in GST.
Down from what?
Down from 12%. That's a major reduction. A big relief for farmers, potentially impacting productivity, maybe even food costs down the line.
And parts too.
Yes, even tractor parts and accessories. They were taxed at 18% before. Now they also dropped to 5%. It simplifies things and lowers costs right where it's needed, supporting a huge part of the economy.
Okay, that's a significant boost for agriculture. What about other work vehicles, trucks, buses, three-wheelers?
They get good news too. Commercial vehicles and three-wheelers also see their GST rate cut from 28% down to 18%.
So across the board for commercial transport.
Yep, trucks, buses, three-wheelers. It's expected to give a nice boost to the logistics and transport sector. Could help with supply chain costs, maybe even the price of goods eventually.
And component manufacturers, the parts that go into all these vehicles.
Simplified there as well. All auto components will now have a uniform GST of 18%. Many were at 28% before. So that's a welcome reduction, streamlines manufacturing costs, could make things more competitive overall.
Okay, so we've covered the tax changes across all these different vehicle types. The natural next question is, which companies are really set to gain from all this? How does it change the playing field?
Absolutely. Let's look at the big players. Maruti Suzuki, for example. They stand to gain, well, massively from those small car cuts.
That's in a bread and butter, right?
Exactly. And the numbers really tell the story. A huge 68% of their sales mix used to fall under that old 29% GST slab, which is now 18%.
68%.
Yeah. And another 31% of their sales were in the old 45% slab, which is now down to 40%. So with almost 70% of their volume getting the biggest tax cut, they're not just getting a boost.
They're potentially cementing their lead.
Precisely. It could really widen the gap in the mass market. It reshapes the competitive landscape, potentially for years.
That's a massive advantage. What about Hyundai? They're a big player too.
Hyundai is also in a strong spot. About 60% of their sales mix was in that old 29% slab, now 18%.
Okay.
And another 37% were in the old 45% slab, now 40%. So they're definitely well placed to benefit. They have a good balance across segments.
And Tata Motors, they've got quite a diverse range now.
Tata's looking good too. A substantial 77% of their sales mix was in that old 29% slab, now down to 18%.
Even higher percentage than Maruti in that bracket.
Yeah, percentage-wise. And what's interesting for Tata is that about 12% of their sales are already EVs.
Right, which have low GST anyway.
Exactly. EVs already enjoy that low 5% GST rate. So this gives Tata an extra strategic advantage in that growing EV market, aligning well with future trends.
Okay. Then there's Mahindra and Mahindra. They're huge in SUVs and utility vehicles. How do they fare?
M&M, with their big SUV presence. 43% of their sales mix was in the old 48-50% slab, which is now 40%.
Okay, so a decent drop there.
And another 52% of their sales were in the old 28-31% slab, now down to 18%. So they're positioned as a major beneficiary too, especially given how strong SUV demand is in India.
And tractors too, right? We talked about the 5% rate.
Exactly. They benefit from both ends, the SUV boom and the relief for the agricultural sector with tractors. Very well positioned.
So clearly some big winners. Is there anyone on the losing side of this, any major player negatively impacted?
There's one main example, though. It's quite specific. Eicher Motors.
Royal Enfield's parent company.
That's right. They have something like an 85% market share in that premium motorcycle segment, the bikes above 350 cc.
Ah, the ones facing the tax hike to 40%.
Precisely. So they're directly and, well, adversely impacted by that tax increase from 31% to 40%. It's a niche segment, volume-wise, but it's where Royal Enfield really dominates the premium end. They'll need to figure out their pricing and strategy there.
Right. Okay, so we've looked at the direct impact on the vehicle manufacturers, but you hinted earlier there's a ripple effect beyond just the automakers.
Yes, that's a really crucial part of the story.
Yeah.
These reforms don't just stop at the showroom. They ripple outwards.
And you said the biggest indirect winners are finance companies.
Exactly. Specifically, the non-banking financial companies, the NBFCs, that focus heavily on vehicle financing.
How does that work?
Well, it's pretty straightforward. If prices drop, demand for vehicles is expected to go up.
Makes sense.
More people buying cars and bikes means more people needing loans to buy them. That directly boosts business for these NBFCs. More loan applications, potentially better loan quality if affordability improves. It's a direct link.
Okay. And you mentioned there were some prime examples of companies heavily exposed here.
Yes, two really stand out. Mahindra and Mahindra Financial Services. M&M Financial. A massive 86% of their entire loan book comes from vehicle financing.
86%. Wow, their fortunes are really tied to the auto sector.
Hugely. And then there's Shriram Finance, another big name. They had about 74% exposure to vehicle financing in their loan book in the first quarter of FY26.
So these become interesting proxy plays for investors, right? Betting on the auto revival through the lenders.
Exactly. They essentially ride the coattails of increased vehicle sales. If you believe the auto sector will boom because of these reforms, these financing companies are a way to potentially benefit from that trend.
And what do their valuations look like? Are they reflecting this potential?
Well, looking at FY26 estimates, M&M Financial trades at about 1.6 times its price to adjusted book value. That's a key metric for finance companies.
Okay.
And they have a return on average assets of about 1.9%, which is pretty solid. Shriram Finance trades a bit higher, around 2 times price to adjusted book, but also has a higher return on assets, about 3.2%.
So different profiles, but both heavily linked.
Definitely. And it really highlights that bigger picture point. How a policy aimed at one industry, like auto, can send waves through the financial system, changing investment opportunities elsewhere.
Okay, expert. So let's pull all of this together. Looking ahead, maybe the next year or so, what's the overall outlook for the Indian auto sector now?
Based on everything we've discussed, our analysis suggests we could see pretty significant volume growth, maybe in the range of 15 to 18% for the major automakers.
15 to 18% growth, that's substantial.
It is. And that's driven mainly by the GST cuts, but it'll likely be helped by other factors too, what we call tailwinds.
Like what?
Things like hopefully a good monsoon season that always helps rural demand, which is key for bikes and small cars, and maybe potential interest rate cuts later on, which would make loans even cheaper.
So a combination of factors creating a positive environment.
Exactly, a confluence of positive factors lining up.
Okay, so just to summarize the key takeaways then. The big winners from this policy shift are clearly small cars, SUVs, three-wheelers, and commercial vehicles.
Yep, those segments see the most benefit.
The broader market generally stands to gain. The main losers, relatively speaking, are those premium motorcycles over 350cc, but that's a very small slice of the market.
It's just 1-2% by volume, yeah.
And company-wise, who should people be watching?
Well, based on our analysis, Maruti Suzuki looks particularly well placed. That dominant small car portfolio gets the biggest tax cut.
Right.
Mahindra, and the Mahindra is another key one to watch. Strong in SUVs and tractors, both benefiting significantly. And in the commercial vehicle space, Ashok Leyland stands out. They're a pure play CV manufacturer. So that cut from 28% to 18% GST is huge for them.
And don't forget the proxy plays.
Absolutely. That expected jump in vehicle sales really points to a positive outlook for the vehicle financing companies. So M&M Financial, with that 86% exposure, and Shriram Finance, with 74%, become very noteworthy in this context. They're indirect beneficiaries, but potentially significant ones.
It's really clear these GST reforms aren't just, fiddling with tax rates. They seem set to cause a pretty significant shift in the whole Indian auto landscape.
For sure.
And the effects stretch way beyond just the car dealers, deep into the wider economy.
Absolutely. Which raises an interesting question, maybe something for you, our listeners, to think about. How might these big policy changes influence not just what people buy or where investors put their money, but maybe also could it spark new ideas? Changes in how vehicles are made or marketed to really take advantage of these new rules, something to mull over.
Definitely food for thought. Now, before we wrap up, we have a very important note to share.
Yes.
We are not SEBI-registered financial advisors. This discussion is for informational purposes only.
That's right. If you are thinking about making any investment decisions based on this, please consult a certified financial advisor first.
Absolutely critical. Well, thank you for joining us on this deep dive today. We really hope this has given you a clearer, more insightful picture of these quite impactful GST reforms.